Nigerian Monetary Policy Committee meets today to preview the decision to be made by Central Bank Governor Sanusi, Lamido Sanusi. I'm now joined from London by Razia Khan, the Head of Research at Standard Chartered. Thank you so much, Razia, for joining us today. You are anticipating, or you think that we will be seeing a 25 basis point rate hike this time round. Give us your view in terms of what we could be seeing coming through from Nigeria. We had a CNBC Africa poll, and it's interesting to note that 45% think that it will be unchanged, while 44% say there will be a hike. So in other words, relatively divided at this point.
Yes, absolutely. And there has been some market uncertainty around this, mainly to do with the banking sector. We do know that the banking sector saw minimal rates of credit extension last year, and the feeling was that the central bank would probably want to see loan growth improving substantially before tightening again. However, we take a slightly different view. There has been a significant enough monetary policy normalization going on since September last year. Let's not forget that as part of the banking sector rescue, the CBN effectively printed the money to inject into the rescued banks. They could do that because at the time money supply growth was fairly minimal. Since then, we've seen very strong increases in the amount of government spending. There are concerns that that additional liquidity may have been helping to pressure the exchange rate. Even though December inflation dropped to 11.8% year on year, the average for the year is still uncomfortably high. For all of these reasons, we think there's a good chance of another 25 basis points, a moderate tightening, to be announced today.
It's interesting to note, looking at that inflation figure, and you alluded to the fact that it has come down in December from November, we're looking at 11.8%. We're also expecting total spending should be declining by around 18% year on year in this financial year. But your view, Razia, about the inflation outlook going forward, one only has to look at other emerging markets and how they're grappling with food inflation. Do you think that is going to be a hindrance?
That is certainly key. Even though we saw the revision of Nigeria's inflation basket last year, and under the new CPI index, food in total has a much lower weighting. So we've moved away from around 64% of the basket, closer to just over 40% of the basket. It's still clear that whatever is happening globally with food price developments is going to be important to Nigeria. Now, for the moment, the evidence locally is that there have been favorable domestic harvests, and so food price inflation probably isn't top of anyone's concern just yet. But the authorities will nonetheless have to be cautious. It's only a matter of time before there is more feed through from international food price pressures in a big importing economy such as Nigeria. And of course, exchange rate stability is going to be key to their overall ability to keep inflation under control.
Razia, you alluded to the fact as well that we have to see loan growth improvement as well to justify an even bigger interest rate hike. But obviously, it's going to be a juggle between the inflation outlook and the health of the underlying economy. You're saying 25 basis points this time round. Going forward, what kind of trend do you think is going to start playing out in 2011? More hikes to come, perhaps?
Well, our view is still for significant tightening still to come. We think the monetary policy rate, currently at 6.25%, will end the year as high as 8% potentially. And this is the reason why. 2011, of course, is an election year in Nigeria. We saw this huge increase in spending over the course of last year. Now, relative to that very high base, spending is expected to decline by 18% in 2011. But if you look at the mix of spending, recurrent expenditure stays high. And the point we're making is that those inflation risks haven't dissipated at all. Foreign exchange reserves have been falling, partly because of the strength of demand for FX, partly because of the depletion of Nigeria's excess crude accounts. And so more is needed to instill some degree of confidence in the market. And we think a rate tightening, some resolve on the part of the central bank that all things considered there is room for tightening and they will do what's needed to stabilize things is required at this point in time. The Nigerian economy should do well in 2011, no question about it, and given the amount of spending that's been thrown at the economy. So the inflation risks, the dynamic, is likely to change.
Razia, I mean, speaking of stability, what about the Naira US dollar cross? We're sitting at around 150, and it's also interesting to note that time and time again we have been talking about the 3% range on the Naira US dollar. How do you see this playing out? Because it is obviously a very costly exercise to ensure that the Naira does not engage in any volatile trade.
Absolutely, and there's been huge debate about this in Nigeria itself, about whether it is right to run down foreign exchange reserves in defense of a particular dollar-naira exchange rate. Now, if you think there's debate about the policy outcome in terms of the interest rate decision, there's probably even more debate about the central bank's foreign exchange intentions. For the moment, the central bank have, of course, tried to calm the market, saying that they have no intention of devaluing or allowing the Naira to depreciate, that if they were ever going to change that midpoint of that band, they would announce so in advance. Now, the obvious question that will occur to a lot of observers here is that foreign exchange reserves have been falling for some time. So at what point will the CBN announce that maybe a slightly higher midpoint of that dollar-Naira band is necessary?
Yeah.